So every day we ask Wall Street's brightest minds to share the one word they believe will describe the trading day ahead. Scott Ladner, what is your WEX word of the day?
I think I'm going to go with under-levered. As far as the U.S. consumer and U.S. businesses are concerned, everybody was really kind of caught up in this SLOOS report. And after the SLOOS report, the senior loan officer survey was loosed upon us earlier this week. People were really worried that credit conditions were going to be tightening a lot in this country, and that tightening credit conditions and tightening lending standards, this type of thing, typically leads to a pretty severe recession, a pretty severe downturn in economic activity. One thing that I think people need to take mind of is the fact that U.S. consumers are flush. We still have about $800 billion of excess savings. Everybody's got a job. Everybody's getting wage increases and raises. U.S. corporations are really flush. The revenues at all-time highs. And so, in terms of like borrowing capacity or the need to borrow money, actually, we think that U.S. consumers and U.S. corporations can probably go like 6 to 12 months without having to actually really tap credit markets and really without having to tap leverage type products. And so, the fact that this SLOOS report and kind of credit standards are starting to tighten a lot, it may just not be quite as important as it has been in the past. And so, we think that needs to be taken account of the fact that U.S. consumers and U.S. corporations are really under-levered right now relative to where they usually are at this point in the economic cycle.
Yeah, that's really an interesting point, Scott. At the same time, though, we do have recession worries, the banking crisis worries, possible debt limit worries. So when you're talking to your clients, or at least maybe when they're calling you right now, with so much going on, what are you telling them when it comes to portfolio protection? We had some guests all week giving us different ideas about how to protect their portfolios. What are you advising?
I think for a little bit of time, Frank, it does still make some sense to play a little bit of defense in the U.S. equity markets, at least. And by defense, what we really mean is anti-cyclical or counter-cyclical types of sectors. So think communication services, think tech, think healthcare, things that aren't really tied to the economic cycle. So we think that still makes some sense here for the next month or two. But outside the U.S., we actually think a better place to look for protection is in Asian equity markets. In Asia, those markets can benefit from Chinese consumer that's really burgeoning, Chinese inflation that's really coming down hard, and a dollar which is probably peaked because the Fed is done.
All right, I want to run one more other thing by you. So we're getting some new fund flow data from Bank of America just a few minutes ago. One of the key findings, tech funds seeing $3 billion in inflows in the past week. That's the biggest since December of 2021. At the same time, gold saw $1.3 billion in inflows, biggest since April of 2022. So which is it right now? Which is better for a safe haven play? Growth or maybe even gold?
We're not big fans of gold here. In terms just from a technical standpoint and from an opportunity cost standpoint, we do actually think that the tech side of things for a while, even though it is crowded still, but things can remain crowded and they can get more crowded for a while. So I'm not saying that tech is going to be the place to be the entire year, but for the next month or two, we think that's a much better play than gold.
Really? That's very interesting. So do you think that growth is just back in favor? If you look at Meta, Meta shares have pretty much doubled year to date.
Yeah, we do, because the fact if the Fed is done and if we have seen peak U.S. interest rates, then that means that multiples can really expand from here. 2022 is all about multiples contracting, and those highly levered, or not necessarily highly levered, but highly valued firms in the tech space, just getting derated like crazy. And 2023 we think is going to be about disinflation, about rates coming back down, about multiples being able to re-expand. And so in terms of like a mirror opposite, we actually think 2023 has the opportunity to deliver pretty strong growth for the tech firms because they can get re-rated back up on the multiple side.
Scott, I just want to be clear. So you're saying there's not only going to be a pause, but there's going to be a rate cut this year?
No, I think the rate cut calls might be a little bit ahead of themselves. Okay. But we do feel pretty strongly that the Fed has seen peak. We have seen peak rates, and the Fed is really done. I think everything we've seen out of the CPI and PPI reports this past week is really pointing very strongly in that direction.